This podcast is produced by OnPod, a video content studio near you.
Hey everybody, we're here with Nico de Bony, and he has created a course for option strategies. So we're going to be here, we're taking some questions, and Nico's going to tell us about investing, what makes a good investment, and everything in between. So Nico, how are you?
Very good, thank you. And you?
That's good, I'm great. So do you want to jump right in? Our first question will be, what makes a good investment?
Yeah, sure. A good investment, I think, is something that you understand really well.
Mm-hmm.
Ideally, people would invest only in things they know. Sometimes they are looking for hot stocks or to chase the latest trend, but if they don't understand it, they usually buy at the top like everybody else and then they sell at the bottom like everybody else.
Mm-hmm.
So there's a reason why we see those bubbles is because people chase things they don't understand.
True. Yeah.
So I would say, yeah, if you had to start and you wanted to pick stocks, at least pick stocks that you understand, brands you buy from, something from your industry, something like that.
Mm-hmm.
Just because it makes it easier, removes one roadblock from getting potential results.
Yeah, totally. Like follow the business, right? If you know the business, you kind of know how it's going to perform over time. That's what you want to know, right?
Yes, but there's a caveat. The thing in the stock market is that in the long term, fundamentals matter, but in the short term, they don't.
Okay.
Short term is really a voting machine. So whatever is popular, where money flows, there are other more complex things in the background. But in the long term, if you look over 20, 30 years, maybe if you really think a business has some good potential and the economy doesn't change completely like we've seen several times in the past few decades, maybe it will work out. But there is no guarantee like in the past because everything is moving so much faster nowadays.
Right.
But yeah, in the short term, it doesn't matter. It's all about expectations. That's one of the first lessons I learned, actually.
Okay.
I invested in Google back in 2005, 2006. I thought it was a great company,
Mm-hmm.
and they had great earnings,
Mm-hmm.
but their stock tanked. And I was like, what's going on?
Right.
It doesn't make sense. But it was all about expectations. The investors had in mind a certain level of revenues and profits and things like that.
Mm-hmm.
And when Google increased their revenues, but not as much as expected,
Mm-hmm.
the stock tanked. So that's why it's not so much about, if you think it's a great company and it will do well, it's about what the market expects.
Right.
And so if you think right now the bubble is in tech and AI,
Right.
because people think it's going to go straight line until the end of times, but eventually, the Nvidia, which is the leader right now, will get so much money that it will attract competitors who will develop better products or products at a lower price point.
Right.
And then the market share of Nvidia is going to go down. Like it cannot just go on and increase forever at the same pace. So people will be disappointed at some point.
Mm-hmm.
And because the stock market price reflects expectations, at some point it will stop the rise we've seen. But yeah, it's something people don't understand. Usually when they start,
Mm-hmm.
they really think it's a great company, I should buy it. It's going up, I should buy it. But they don't understand the mechanics behind it. So that's one of the things really to understand when you get started.
Right. So if you like the business, wait for a retracement, and then it's like a long-term relationship. You ride it through the waves, right?
Yeah,
Okay. Kind of.
kind of. Yeah, it's there are some things that if you really like Kodak 30 years ago and you
Mhm.
invested in it, we all know how it turned out. But it's about having a strategy, sticking to it, but also adapting your plan to big trends that are changing, not the day-to-day news that you might see.
Okay.
But if there's something major that might impact your business, maybe you might want to rethink it. Like, for example, all the people who thought call centers and customer service chat people were actually a great idea to invest in. As soon as AI came in and ChatGPT came in, they should have rethought that business model because now, those jobs are being eliminated faster than people can understand, and other jobs are coming on the chopping block as well.
Yeah.
So as long as nothing major happens, sticking to a strategy and a plan is good. But people shouldn't put blinders on and not look at it for 20 or 30 years because in most cases, it doesn't work out. We think about people who invested in Apple 20 years ago, Microsoft 20 years ago, and sure, they made a lot of money, but most people don't think about the 99% of companies that actually finish at zero because they go bankrupt or something like that happens. So we only think because of the bias we have and what we see in the media of the success stories, but we don't think about most of the companies who don't make it.
Mm-hmm.
And so if someone invested in a company like a bank in Europe before the financial crisis, today it's still down like 80%.
That's crazy. You never know what's going to happen.
Yeah, or like the airlines before COVID.
Mhm.
You know, everybody jumped on it thinking, oh, they will go back to their level before they never did. So you have to really think about, you know, things you understand long term, but as well be ready to shift your perspective and your approach if anything major happens that will impact the economy and the stocks you invest in.
Okay, so that being said, what would you say is like a simple investment strategy with all these things in mind? What would you recommend to people?
For most people, I don't think they have the time to do the research, so and to stay vigilant about the big trends and things like that. So, like a broad-based ETF is usually the best approach. Ideally, with an option strategy to mitigate risk,
Mhm.
to limit the risk, because even those big ETF can fall, and they have been lost decades. Like people who invested at the top in 2001,
Mhm.
it took them 13 years just to get back to even before inflation.
Oh my goodness. So those of us who don't know, what's an ETF?
So an ETF is like a basket of stocks.
Okay.
Usually it's maintained by like an ETF provider. So they do the work for you of picking the stocks and rebalancing it.
Mhm.
There's a fee for that, but usually it's much lower than mutual funds.
Okay.
So that's usually the first step people take when they go from like a financial advisor at the bank to something better. It would be like a managed ETF where you pay 10 times less the fees, but you get basically the same thing.
Okay. So it's a bunch of stocks, and because there's so many of them, there's less risk.
So yes, but more and more we see ETFs that are different in the sense that they could be like a single stock ETF or leverage ETF. So ETF used to be that safe thing where you invest in 500 companies and so you're limiting the risk.
Yeah.
But more and more people are looking for a leverage play on a single stock. So they will buy like an ETF on Nvidia does like 3 times the return, but both ways. So if the Nvidia stock is up 5%, that ETF would be up 15%. But the reverse is also true. And over time, it's a really risky bet. But I look on Google Trends daily and I look at different things. And leverage ETF is one of the keywords. When you see it peak, usually it's close to market top. And the other way around, people look for inverse ETF.
Okay.
So it's an ETF that goes up when the market goes down.
Okay.
And the peak of people searching for it on Google was April 8th, you know, the day of the law of the market after the announcement of the tariff.
Right.
So,
Okay.
yeah, people are using ETF differently nowadays. So that's why you cannot just say to someone, buy an ETF like 10 years ago when it used to be a basket of diversified companies, ideally diversified markets and asset types and things like that. But the idea still remains that an ETF is usually safer than a stock because it includes several companies. And so it's very unlikely that the whole ETF would go to zero like a company could.
Okay.
And also, if you go for like an ETF like the SPY for the SP 500, it's the 500 largest companies in the US, they keep replacing the lowest performing companies with the better performing ones.
Okay.
So it's like a constant rotation of, in theory, you always have the best ones, and it's less likely that a company would be bankrupt in that bucket of the 500 best. It can still happen, but it's less likely.
Right. Okay. So that being said, what tools should an investor know?
So the one tool that changed my life and my investing perspective was options. There are many things you can do with options. Most people either don't know what they are or think they are only used for speculation.
Yeah.
But really, it's one of the most flexible tools you have because you can use it either to be very defensive or to be very speculative or anything in between.
Right. Defensive. Like when I think of options, I think of day trading. So can you go into a little bit more about?
Sure.
Okay.
So yeah, that's one thing I teach in my course. So basically, that's how I started with options because I was on Reddit and I saw Wall Street Bets, which you might be familiar with, and I saw how people were using options either to make a lot of money or to basically have a margin call and be bankrupt.
Right.
And so I figured, okay, this looks like a very good tool, but I need to learn it because I don't want to end up like the people showing the porn loss, of their account going to zero.
Yeah.
And so the defensive play with options, and the thing I started with is, let's say you want to buy 100 shares of a company, a stock worth $100. So 100 times 100, $10,000. So you could put the $10,000 and that would be your capital at risk. But potentially it could go to zero. If you buy a call option on it, so it's a contract that gives you the power of buying those shares within the next year, you could buy that for like 20% of it, so $2,000. Okay. So basically, you could control $10,000 worth of stock for $2,000.
Wow.
And so both scenarios, you control $10,000 worth of stock, but one scenario you could lose 10K. The other one, worst case, you lose 2K. And so that's a defensive play of options, is that you could get the same upside, but you have like very limited downside.
Yeah, a lot less risk.
Exactly.
Yeah.
And so it's very like asymmetric when you look at the payoff ratio or the risk profile of that investment, because from day one, you know, the worst you lose is that 2K versus the person who bought the stocks, they can lose a 10K. And you can do anything in between, because you could also put 10K in call options.
Yeah.
And this way, if you're right, the payoff could be 3 times what you get in stocks.
Mhm.
But if you're wrong, you lose more money. So, you know, you have to think. But I just want to tell people that it's the best tool, regardless of your risk profile, because you can be defensive, speculative, or anything in between. And I usually go in between, because I like to have more upside than owning the stocks, but less risk. So that's my approach.
Okay, so it sounds like there's a lot behind this. Like, how would you keep someone from overcomplicating investing? Like, is it complicated? Is it not complicated? Do you think people tend to overcomplicate it? Or what are some main elements that you teach in your course that even a beginner could understand?
So I think that the one thing people think when they invest is you either day trade or you invest for the very long term.
Right.
And it doesn't have to be this way. It can be in between.
Okay.
I actually focus more on like medium term investing. So I like it because I don't have to look at screens all day.
Mm-hmm.
I set up alerts and automatic sell order and buy orders, but I don't have to be constantly looking and monitoring and adjusting things. So I think most people complicate it because they really think, okay, if I don't want to do long-term investing, I have to do day trading, and then you have to be on your phone all the time and watch all the news and try to figure out what's the trend and things like that. So when people ask me what I do and what they could be doing to have less stressful investing, it's really to think more like, you know, medium-term, six months to a year, and to put things in place so you have a strategy that you can follow without thinking about it all the time.
Right. Yeah, because I feel like, especially when you're trying to invest to, you know, make a bigger purchase, like buy a house, or you never know when you're going to need that money. Sometimes long term is not sustainable. Like putting money in somewhere and getting it back 6 months later, I think is a lot more valuable to some people, especially younger people when, you know, they're trying to make larger investments, like I said. So that's a really good option to have.
And that's the other thing I see many people putting money on the side to buy a house.
Mm-hmm.
And, you know, the conventional knowledge or wisdom is you don't put it in the stock market if you need it within the next 2 3 years.
Right.
But actually you can.
Okay.
Because one of the options that I teach is how to put a floor on your losses. So you could potentially buy something like an insurance.
Okay.
And so whatever you put in the stock market, you could know that you will never lose it. Well, you know, for duration of the insurance.
Mm-hmm.
But people could be buying insurance for 2 years on the SP 500, putting the money in there and knowing that the worst case that can happen is they lose the insurance money, which, you know, is not bad, because when you buy insurance, it's not with the purpose of using it. Like when you buy home insurance or car insurance,
right,
you're not hoping to get into an accident or to have your house burned down.
Exactly.
You don't see it as, oh, I lost money. No, it was something you had to do to sleep well at night. And so you could do the same thing with investments in the stock market. If you have money sitting aside, especially now that the interest rates are going down, you're not getting as much on your saving account. You could potentially invest in the stock market. If the stock market is flat, you just lost your insurance money. If it goes up, your upside is unlimited and the downside is capped from the beginning. So there's really so many ways to use options to invest. And it's kind of sad to see how people don't even have a clue that it exists. It's not that they think it's complicated. They don't even know it exists.
Yeah. Like I've been doing business for 2 years. I've been trying to invest for probably 4 years now. And I had no idea that you could put insurance on your investments. That's crazy. So it's definitely a lot that Nico can tell us.
Yeah.
So when things are going up and down so much, so with Trump as a president right now, he's obviously saying a lot of things and making a lot of changes. Do you think that people should follow financial news?
No, most of the time it's noise, really. I think the best example I can see is that a few years back, when the stock market opened, it was down. And there was a headline on CNBC, which is a famous website for investment news and financial news. And they say stock market is down because IBM laid off 5,000 people.
Oh.
And then in the afternoon, the stock was up. The stock market was up, and they reversed the headline. Stock market is up because IBM fired 5,000 people. And so
crazy.
The news usually, first, as I just mentioned, they could interpret it either way, but most of the time it doesn't bring you anything. Like I use it more to gauge the sentiment of the market participant,
Right.
to see if they are very bullish, very bearish, or in between, and to see if there's that divergence I talked about between retail investors and institutional investors. But most of the time, it's not worth making decisions based on the headlines, especially because they have advertisers that push certain things.
Yeah.
And they will never tell you it's the worst time to buy, just like a real estate agent would never tell you it's the worst time to buy a house. So financial media usually are pushing things that they are selling or that their advertisers are selling. And so I try to avoid it to make decisions, but I like just keeping an eye on it just to get a sense of the market. And when I make decisions, usually it's more based on data. So that's why I combine the technical analysis with fundamental analysis. Most people, they pick one or the other. So fundamental analysis is, is it a good company? Is it well managed? Is it good for the long term? Is the industry growing? That kind of thing. Technical analysis, you don't care about the news, you don't care about the fundamentals. You only look at what people are doing, not what they are saying. So are more people buying or selling shares? Are they, selling them at zero levels or not? What is the trend? What is the moving average? That kind of thing. So I would say this is much more useful in making decisions than looking at the headlines because it's unbiased. And also there are always people who know before something big happens.
Right.
And that's why for the past 2-3 years, I've been able to sell at the top, buy at the bottom, like consistently. And people tell me it's not possible. Like I've done it so many times. Like even the past week, I bought silver when it was low after a pullback. I sold it back when it was back at the trend line. I sold it back. I bought it back like 3 times in a row. I was able to sell it up, buy the bottom, sell the up, buy the bottom.
So you mentioned that there are ways that you can find out who knows what's going to happen in the market. How do you find out?
So you don't know who knows, but some people know, and some people will buy or sell things. So they leave trace.
Okay.
So I look for clues in unusual activity, unusual buying or selling from both big players or insiders.
How do you find those big players or insiders? Like, are you looking at a chart? Like, how would one know the difference between a retail investor and an institutional investor?
So one of the things I look at is volume.
Okay.
When you have big volume spikes, usually it's big players who get in or get out.
Okay.
And they tend to do it during the first 15 minutes of the market or the last 15 minutes of the market.
Okay. So volume spikes. So you're looking at a chart for that specific stock. That's what you mean. Okay. Sounds good. And big volume spikes. So that's one of the things that you teach in your course. Okay.
Yeah, how to look at technical analysis just to get the most important indicators. Like I probably use too many of them. And I probably have 30, I focus on 5 or 10. And I only teach like the 5 that beginners can understand and use right away because I don't want to other complicate things.
Right.
But I've tried and used different indicators and found many that work for me. And it's the thing, nothing is guaranteed, but I work with probabilities. So those indicators don't tell me for sure something's going to happen, but it's like, 80% or 90% chance of it happening. And so it's a good bet, like after a pullback to a certain level, based on certain indicators, I know that there's like a very high chance it's going to bounce back. Okay. And so usually when I buy this at that level, I can put a stop just below it if I'm wrong, but most of the time I'm right and it bounces. And so that's how I use technical indicators.
Okay, sounds good. So I'm just going to take this back a little bit. You mentioned investing and speculating when you were referring to options. So what's the difference between investing and speculating?
So I think investing is about trying to preserve your capital first.
Okay.
Because like I mentioned before, if you lose your money, you cannot play the game anymore. So that's why it's the number one rule from Warren Buffett, I think, is don't lose money. And second rule is look to rule number 1.
Okay.
So
don't lose money.
But basically that's it. Because if you lose money, it's going to take so much for you just to get back to even. And then most people, when they get back to even, they sell and they move on because, it was really traumatizing for a lot of people.
Absolutely.
So
yeah, money is security. Nobody likes to lose money.
So investing is really having this rule in mind and putting in place strategies like, the stock market insurance strategy that I teach to make sure that you're covered whatever happens in the market. And I've used it successfully many times, but the most successful I've been was during this crash in April because I actually made more money during the crash than before. Because I usually use strategies where I make money if the market goes up or goes down. But if it stays flat, I don't make money.
Yeah, because with options, you can speculate that it's going to go down like that, right?
Well, so the speculation part could be because it's like a bet, but anytime you invest in the stock market, it's a bet. So for me, the speculation is more people who really want to get rich quickly. Right. And so that's why we see more and more people buying very short-term options. Like I'm talking like less than a day.
Yeah, like day trading.
Yeah.
Right?
So 0 day, that's what it's called, zero DTE options, has been rising at its all-time high, even higher than the bubble of 2021.
Wow.
So yeah, people just want to get rich right now. People just want hot stocks and follow trends. And so, of course, option can be used to speculate and they can make you a millionaire. That's true. But most people actually lose money with options.
Right.
And so they don't realize this when they start and they think it's just, a few dollars there, a few dollars there. But when you add up all the money they lose in those contracts that expire worthless, plus the fees they pay, because usually it's not free, they don't want to look at the total at the end of the year. But I think most people, when they speculate with options, it's like buying a lotto ticket.
Okay.
So
when you don't know the background.
Exactly. That's the way they see it. So they think, okay, I'm probably going to lose that call that's worth one cent, so $1 with the 100 shares, but could go to $100, $1,000. And, I've done it a few times just to try it out and see the thing. And I saw the thrill. Like I bought an Nvidia call 0 day before a tweet from someone that said the news about Nvidia, and then it went up 1,300% in 5 minutes.
Oh my God. Okay. For someone that doesn't know how to do this, don't do that. Okay?
Yeah, no. I just tried it to get a sense because I saw so many people doing it and I wanted to understand so I could better, help people see that, yes, it can work once in a blue moon, but that's not how you will consistently make money. Yeah. And it might not be a good use of your time and money. So.
Yeah. Nico did it first. He's been doing this for years. He knows the ups and downs of the market. So of course, look to Nico to see what to do. But what do you think of robo-advisors?
It's good. I think it's a stepping stone from having a financial advisor do everything for you. Okay. Because most people, when they delegate that task of investing to a financial advisor, like at a bank, they say, do it for me. And basically, they're not responsible. So if, they don't grow their money, they're like, oh, it's not my fault.
Right.
When you choose to have a robo-advisor, you have to answer questions. And even though it's considered passive, you could still change things around if you wanted, like tell the robo, oh, I want to put more in stocks or more in bonds or add this, what that. So I think it's a good stepping stone. That's what I did. When I started, of course, like most people, I started with a financial advisor at the bank. And then when I wanted to have a bit more control, I went to Wealthsimple to get that robo-advisor for low fees. And then I moved on to other things. So I think it's a stepping stone. It's definitely better than just having someone do everything for you. But you shouldn't just rely on it 100% because they can still make mistakes and they are configured by the company that makes them.
Okay.
So they might not offer some of the things that you want. And that's one of the reasons why I started to move from robo-advisor, because I wanted to invest in other assets like, gold and Bitcoin and other things that were not offered within the robo-advisor very safe, very general ETFs. Right. But it's a good way to start if you're not sure how to build a portfolio, because most people don't. And so having a robo-advisor build a portfolio for you based on questions you answer is a good way to get an idea of how to build a portfolio.
Okay. So before getting a robo-advisor, let's go back to the stepping stones. What's the very first thing that you would do as someone who had to start all over again? Like, where would you start learning about investing? Like something very basic.
Yeah. I think there are a ton of resources, like free resources on YouTube of basic investing, investing 101, where they explain what is a stock, what is an ETF, how you open a broker account to invest money, the type of accounts.
Right.
So those basics. So learning this before starting, don't start by picking a company.
Right.
Like start with something more broad, like a, broad market ETF. There are even like ETF for the whole world. So you don't even have to invest in one country. You could invest in it's called MSCI.
Okay.
And they have a bunch of ETFs where you can invest in the whole world. So if one country or one continent is going down, like, Europe is not going very well right now, well, another one might be going up, like emerging countries. And so usually there are cycles. So if one is doing well, the other one won't be doing as well. So you won't get amazing returns like investing in a hot stock like Nvidia, but at least it's more likely to grow over time and to minimize the risks.
So is that a good way to hedge against inflation?
No, not really.
Okay.
So hedging against inflation is something that people misunderstand. They think, oh, I only have to get more than the 2 or 3% that the government says.
Right.
Well, first, we've been to the grocery store, so we know it's way more than that. The second thing is actually the worst part of losing money is not inflation, is the money printing from government and central banks.
Okay.
It's the debasement of currency. And so the best example I have is look at the price of houses.
Mm-hmm.
Like a house today is not worth twice as much as the same house 10 years ago.
Yeah.
It's simply not.
crazy.
And the main reason you can see that it makes sense today is because the money supply has like doubled.
Yeah.
So if you have twice as much money going after the same amount of goods, of course the price is going to go up. Doesn't mean the house is worth much. It means your dollars is worth less. And so the main thing people should at least try to do with investing is to maintain their purchasing power. And then if you can go beyond that, it's great. But yeah, the debasement is more like 10 to 15%.
Okay.
So I try to aim for at least 20% just to stay ahead.
Yeah.
But yeah, if people aim just to beat inflation, they won't stay ahead and they will just keep losing purchasing power.
But is that where Bitcoin comes in then? Because I've heard that Bitcoin does not inflate because there's a limited supply. So how does Bitcoin fit into this whole thing? Like, do you like cryptocurrency? You mentioned before that you did have some
Yeah.
assets in cryptocurrencies.
Yeah, it's one of the reasons why I started looking at gold, Bitcoin, silver, basically anything a central bank cannot print.
Right.
So they can print, digital dollar bills because they don't print much money physical nowadays, but you get the idea.
Mhm.
But yeah, anything they cannot print, like oil, like gold, silver, copper, and Bitcoin, which is now like a digital gold. It's
Okay.
more and more accepted as such. Other cryptos are more risky, but I like having a diversified portfolio of alternative assets like this, especially now that you can invest into them through the stock market. So you can even put them in like a RSP or TFSA to keep the growth, without too many taxes on it, at least for a while with the RSP. But yeah, it's a good way to invest in something that if they continue issuing more debt and printing more money to finance the debt, like they have done during the pandemic, having assets that go up in price and that are easy to buy, and like a house, I think it makes sense. And that's what I've been doing for a portion of my portfolio. And this has really helped since 2020 for sure.
Nice. Okay. So do emotions affect investing?
It's the main thing.
Okay.
Most people think they have a plan until something happens that, they ditch the plan to follow their emotions. So that's why they sell, they buy at the top, they sell at the bottom,
Right.
and they follow trends. And it's the worst possible thing you can do to act on emotions.
Okay.
But most people do. And so that's why there's so much need for people to get, coaching, which is part of what I offer. I didn't want to just offer the training like most people. Most people give you a training course like self-paced and, do it and you'll be fine. But first, most people don't do the course. They buy it, but they don't follow through. And then they don't actually put it into action. And so that's one of the main thing I found where I help people, because initially I was acting a lot of emotion like most people, but I've learned to actually do the reverse.
Okay.
So I still feel those emotions, like, during the April lows, I still felt the fear, like most people, of the market is going down like very fast. This is it. This is the big one. It's going down, blah, blah. But I still bought at the bottom because I knew that I had to do the opposite of what the emotion was pushing. And same thing, in post the Trump election, there was like euphoria in the market.
Right.
And so I sold again close to the top for both Bitcoin and other things because I was just seeing the euphoria around me. I felt a bit of it as well. But, it is the kind of thing where you have to acknowledge your emotions and then you have to take a step back and to make sure that you don't act on those emotions, because then you will regret it. So it's the main thing people need help with. And the more they practice not reacting on emotions, I think the more successful they will be as investors and traders.
Right. So do you think people should make a written plan, or how do you think the best way to...
A written plan can be good because when you put things to paper or digitally, at least you put more thought into it and you can refer to it later, especially during those times when it can be hard to stick to your plan.
Yeah.
It doesn't have to be that way. For some people, they can just, get a plan and stick to it. But it does help, I think, for most people to to write it down because it's a good reminder when things go bad that you have a plan and you should stick to it. And you shouldn't go with the general FOMO or euphoria or the stress where everybody says sells, which is usually a really good time to buy. So.
Right. That's so true. So counterintuitive. So when you feel that gut feeling, when you're scared, buy more, depending on the business, of course. So
one thing related to that is many people, and that's a mistake I did too in the beginning, average down. So they buy something thinking it's going to go up, and then they just buy the dip. But they could be doing this for 10 years, 20 years. Maybe the stock will never recover.
Right.
So that's another lesson I learned early on that I teach people too is, only to reinforce a stock during a pullback if it's going the way it's supposed to be going.
Okay.
Because too many people are averaging down and losing so much money just because they think, oh, it's going to go back up. It's just a temporary thing. And so I've done it. I've lost thousands of dollars with this, and I've seen other people do it. And that's one of the lessons too that I learned, which is related to what you just said. So I figured might as well plug in it.
Yeah, there are caveats to everything, right?
Yeah. It's hard to compress, everything I've learned over the past few years and decades into just a short podcast. But at least if it can give people a few ideas of there are many things to look out for, and if you do it on your own, you can still do it, but it might take years and might be really much harder than it has to be. So if you can find someone, doesn't have to be me, but find someone to help you through the journey, someone who has gone through it first. This can help both the emotions and the portfolio.
Yeah, totally. No, trial and error is something that everybody has to go through, but make sure that you find the right teacher for sure.
Yeah.
Okay. Can your simple strategies beat mutual funds? Oh yeah. Okay, great.
It's not even
no brainer.
It's not even a question. Well, first, mutual funds have such high fees. Then you start with like a massive disadvantage. Like for example, the SP 500 has averaged about 6 to 7% per year of growth for the past 20 years, I think. But if mutual funds take 2% off the top right from the start, whether the stock market grows or not, you're already losing like 20, 30%. This is huge. And over time, it compounds. And when most people realize that when you look at a typical portfolio in mutual funds over 30, 40 years, your bank is probably making more money than you, but you take all the risks.
Right.
So it doesn't make sense.
Yeah.
And they don't even do active management. They copy what everybody else is doing. So it's like a cover your ass strategy where, if you do like everybody else and you're wrong, well, you can say, well, so were other people.
Yeah.
And it's actually one of the least important criteria. They did a survey of financial advisors in banks, and they said, what is most important for you? And being right and picking the right asset wasn't at the top.
Wow.
For them, what's important is that people keep their assets under management because that's how they make money. So that's why you have all those keep your money in the market and don't time the market. And those things are like marketing slogans from people who benefit from you keeping the money in the fund regardless.
Right.
But for most people, leave it and never adjust your strategy is really counterproductive, but it's really bad for you. So people don't have to be super active, but just to recognize there are trends.
Yeah.
And so the market will usually go up for a few years, then go down for a few years, go up for a few years, go down for a few years. And it's funny because since 2020, it's like the perfect stair. You can stay 2 step ups, 1 step down, 2 step up, 1 step down. It's like the perfect retracement of 50%. It's like amazing. I love math. And looking at those ratios, I'm like, this is crazy and amazing, but it also helps to not predict, but have a good idea of what is the probability of the market going up or down based on where it is.
Yeah.
But yeah, basically you could be getting out. I never plan to get out at the top and to get in at the bottom, but I plan to get 80% of the growth and to cut my losses before I lose 10%.
Right.
And so most people, they aim for the perfect top and bottom, but unless you have some luck, it's not possible to consistently do it. But with this approach of trying to aim for getting most of the growth and avoiding the big losses and just staying in cash for a few years, like this is one of the main advantage for everyday investors. They can stay in cash. Big players cannot. Because if you're investing in mutual fund and stay in cash, you'd be like, why am I paying you 2%? So they would take their money out. So they always want to stay invested, even if it's not good, just because of the thing that they're scared of, which is people leaving their money from the fund. So
yeah, this is cool. A little behind the scenes on banks too, and how banks work. Okay, that's neat. So should investing be taught in school, do you think?
Yeah, definitely. It's one of the life skills that I don't understand why people don't teach it in school. Like, just the basics. I think there's such a big industry benefiting from people thinking it's too complex for people to manage themselves that, one way or the other, it's like people think it's not for them, it's for other people. They think it's like medicine. You wouldn't be it's practicing medicine on you. And so they think investing is the same thing. It's only for professional. But really, there have been studies after studies showing a monkey can usually pick better stocks than, a portfolio advisor on Wall Street with like 30 years of experience. Because like I told you before, it's not about the fundamentals. It's about luck and trends and where the money is going and flows and if the government's printing money and all these other things. So it's not so much, is it a good company? Is it well managed? Like they try to let you think it is. So that's why they don't really know how to pick good stocks and they just keep to the safe stuff that has worked for the past 40 years. But to me, it seems like since 2022, the 60-40 portfolio is broken. Like it doesn't work.
Yeah.
The bonds were sold as that safe portion of your portfolio that goes up when the stock market goes down.
Right.
And it worked for 40 years because inflation was going down and the interest rate was going down. And bonds, they go up when interest rate goes down. It's the way they work.
Okay.
But since I feel like we've now started a new, maybe 20 to 40 year cycle of interest rates going up and inflation going up, those assets won't work the way they worked for the past 4 years. But most people and most financial advisors, they only look at the past to predict or project the future. Yeah. And so they think, oh, it has worked well, it should work well. But I think like it's broken and people should look for alternative things. It's not financial advice, of course, it's my own opinion, but it's just something I teach in my course too, why I think the 60-40 is broken and what to do instead. So
yeah, COVID really rocked us, because after COVID, everything went up, inflation started going up, and people didn't know how to deal with anything.
Yeah,
even the money and other systems. So that's crazy. But it's good that you realized that pretty soon off. If you had $1,000, where would you start putting that money? What would you do with it?
So I have several people who approach me with this question regularly because most people don't have much to start. And the one thing I usually tell them is don't put everything in one stock.
Right.
Like, just as a friend would tell you, not as an advice, but it's just like, this is the worst possible thing you could do. If I was starting with $1,000, I would probably put half of it in like training, just to learn something that can be a life skill that can make me avoid costly mistakes and become a better advisor. Most people, including me, initially think you can just learn from free resources or you don't even need help. You can just do it on your own. And the worst possible time to invest is when the stock market go up when you start, because you think you're a genius and you don't pay attention and you get overconfident. And that's why people lose so much money or everything, because they just think, oh, it keep going up. I'll put everything, I'll borrow money. Like right now is the highest time in history that people have borrowing so much money to invest in the stock market. Like it's higher than in 2001.
Oh my God, that's crazy.
Yeah.
Borrowing money to put in the stock market.
Yeah. So how do you think it's going to turn out? Like it always goes one way. People borrow when they don't have any more money to invest.
Right.
But eventually the stock market runs out of buyers.
Yeah. And you know what? You have to pay interest on that too. So
yeah, but they don't care because they look at the growth. And so they think I can pay like 2% interest if I can grow it at 4% or whatever, or 10% or 20%. Or they look at Nvidia with the 70% growth since April, and they think, oh, I don't care paying 10% interest on the loan because I can grow it much faster. But they don't realize that this is usually a top indicator for the market, at least temporarily. It doesn't have to be like a massive crash like 2001, but it could be the round market before a pullback, and then depending on how the market reacts to the things, it could go back up or be the big one that retrace like 80%, like we've seen in 2008, 2001, and other times in history. But yeah, if I had $1,000, I put half in trading or coaching and half into investing, because one of the mistakes people do is they try to invest without real money. So they use a demo account, which is great to try it out, to get you familiar with the mechanics of it. How to buy, how to sell, the different type of orders, the interface of the platform. But you get overconfident with fake money because you take more risk, and so maybe you get more return. So it's good for a few weeks to a few months. But I usually tell people, as soon as you can, invest with real money, because you will never react the same way.
Yeah, emotions.
And start small. Yeah, start small and grow up over time. And don't get FOMO. There will always be opportunities to invest. You don't have to think this is now or never. Like this is another thing that people think, especially when they see stocks or crypto going like vertical. They think, oh, it's now or never. And usually, this is the market top. But yeah, I would definitely spread the money, spread the risk, and know that even if you lose the 500 in the stock market, the 500 you put into your training, that is a life skill you will never lose.
Yeah, that's something that I've never heard. Like most people say, okay, put $1,000 into the S&P 500 ETF so that you get that basket of stocks. But I think training is a really good idea because, like you said, there is a lot to know in the market. It can be complex, and get a good confidence base before you really start going into all the crazy mechanics, right? So
Yeah,
that's a really good. That's a really good tip.
and I think the SP 500, just as a brief thing, used to be like a no-brainer recommendation for most people. But I think since the tariff war started, this is no longer the case. Like this changed so many things worldwide that may affect both the US economy and the worldwide economy, that the US still attract a lot of money into its stock market. But I think this is going to be still, the future is not going to look like the past because something has changed. Right. People realize that, if they invest in the US, it might go against them. So it's not the no-brainer it used to be. It's still a good option, but just something for people to keep in mind.
Yeah, because the S&P is an American company and the States is a little bit funny right now.
But it's the most popular ETF worldwide, the SP 500. So most people are usually familiar with it once they start picking their own stock or using a robo-advisor. But it's just something that if they look at the past 4 years, they might think it's the no-brainer thing that always goes up if you wait long enough. But there are many indicators and long-term cycles that point to maybe the start of the end for the US exceptionalism, which might mean that the stock market goes nowhere or goes down for the next 10 years or more. And it could be either in nominal terms or it could be in real terms, inflation adjusted. Yeah. So if the inflation really runs hot because Trump looks like he wants to restart the growth to try to match the debt, well, inflation is going to go back up and assets are going to go back up. So the market might be up, but just like the house we talked about before, it's not because your assets are worth more, it's because the dollar is worth less. So just something to keep in mind with regards to the investing in the US, which is still a good thing to do, and I do it, but not the no-brainer it used to be.
Yeah, fair enough. So yeah, invest some money in some courses, some training, get that background knowledge, and yeah, thanks so much for your time, Nico.
Well, thank you.